Hey everyone, and welcome back for another deep dive. Today, we're going to be talking about something that I think is really interesting,
Oh, yeah.
and something that I think a lot of people either lived through or have heard about but may not fully grasp. The 2008 financial crisis.
It's fascinating stuff.
And it's something that even today, has a lot of relevance to the way that our financial system works and even some of the things that are happening in the world today.
Totally.
I'm really excited to have you here to kind of break this down for us because I know you've spent a lot of time thinking about this and studying this, and
Sure.
I'm really curious to get your take on it.
Well, you know what I find really interesting about it is how seemingly small decisions can have these massive ripple effects. You know what I mean? Like
Yeah.
one person gets a mortgage they maybe shouldn't have gotten,
Right.
and suddenly the whole world is in a financial crisis.
Yeah.
It's
yeah.
wild.
It's like a butterfly effect almost.
Exactly. It's all about psychology too,
Yeah.
herd mentality and biases, all these things come into play.
Well, let's rewind a little bit. Okay, let's go back to the early 2000s.
Okay.
Think low interest rates,
Yeah.
seemingly good times,
Yeah.
and everyone's like, hey, home ownership.
The American dream, right?
Yeah, it's within reach now.
That's right. And banks were giving out loans left and right, sometimes without being too careful about who they were lending to.
So it's like easy money. A little bit of overconfidence maybe.
Oh, yeah. There was definitely a feeling like the party would never end. And as demand for houses went up, so did the prices.
Right.
It was a classic bubble.
And everyone thought they were getting rich.
Before, my house is worth a fortune. But it was all built on shaky ground.
And then into the subprime mortgage.
Ah, yes, the subprime mortgage.
For those who may not know, can you explain what that is?
Sure. So a subprime mortgage is basically a loan given to someone with a not so great credit history. You know, maybe they missed some payments or had some financial troubles in the past.
So it's riskier.
Exactly. And these subprime mortgages started to become really popular, which, as we'll see, added a whole lot of risk to the system.
Right, because if those borrowers couldn't keep up with their payments then,
Yeah.
things could go south pretty quickly.
Oh, yeah. It was a disaster waiting to happen.
And this is where things start to get really complicated and a little bit mind-boggling.
Buckle up.
Okay, so we've got these mortgages, both prime and subprime, and they're getting bundled together into these things called mortgage-backed securities, or MBSs.
Right.
And then, just to make things even more fun, those MBSs are sliced and diced and repackaged into something called collateralized debt obligations. CDOs?
Yeah.
It sounds like a recipe for disaster.
Well, it kind of was. They were so complex that even seasoned investors had trouble understanding the risks involved.
It's like a mystery box of investments where you don't really know
Exactly.
what's inside.
It was a gamble.
And to add fuel to the fire, we've got this concept of leverage.
Oh, yeah, leverage.
Can you explain that a little bit?
Yeah. So basically, financial institutions were borrowing money, sometimes huge amounts of it, to amplify their returns.
So it's like they were doubling down on their bets.
Yeah, you could say that. But leverage is a double-edged sword. It can magnify your gains, but it can also magnify your losses.
And as we all know, things did eventually turn sour.
That they did. And as 2006 turned into 2007, those cracks in the foundation really started to show.
Right. Like the party was winding down.
Yeah.
And people were starting to realize maybe we went a little overboard.
Yeah, that easy money started to dry up. And housing prices, which had been soaring for years, suddenly started to fall.
And when those prices started to dip, people who had taken out those subprime mortgages found themselves in a really tough spot.
Oh, yeah. Imagine owing more on your house than it's actually worth. It's a terrible feeling.
Yeah, like you're underwater.
Exactly. And as more and more borrowers started to default, the value of those mortgage-backed securities, those MBSs and CDOs, started to plummet.
It was like a chain reaction,
Yeah.
ripping through the entire financial system.
Absolutely. Financial institutions that were heavily invested in those MBSs started to see massive losses.
So we've got falling house prices, surging defaults, and these complex financial instruments imploding. It's like a recipe for disaster.
It was a perfect storm.
And it's at this point
Yeah.
that we really see the human element of this crisis come into play.
You're right. Human psychology played a huge role in how this all unfolded.
So let's talk about that a little bit. We talked about herd mentality before, that instinct to follow the crowd. But can you explain why we do that?
Well, it's partly because we're social creatures. We look to others for cues on how to behave, especially in times of uncertainty.
So it's like safety in numbers.
In a way, yes. But in the financial world, that can be really dangerous. Because if everyone starts selling their assets in a panic, It creates a downward spiral that can be really hard to stop.
And it feeds on itself.
Exactly. Fear begets more fear, and pretty soon you have a full-blown crisis on your hands.
So it's not just about the numbers. It's about how people react to those numbers.
That's a crucial point. It's about fear and uncertainty and how those emotions can spread like wildfire.
And it's not just individual investors who are susceptible to this kind of herd mentality.
Yeah.
Even big institutions can get caught up in the frenzy.
Oh, absolutely. They see their competitors selling off assets, and they feel pressure to do the same, even if it goes against their better judgment.
So you've got this cascade of selling, this downward spiral that's feeding on itself. And it wasn't just contained to the U.S. This was a global panic.
That's the thing about the global economy. It's all interconnected. When one part of the system starts to crumble, the rest of the world feels the tremors.
And then comes September 2008, a month that will forever be etched in the minds of anyone who lived through this crisis.
Lehman Brothers.
Lehman Brothers, a massive investment bank, collapses under the weight of its toxic mortgage-related assets.
It was a shock to the system, a sign that no one was immune to this crisis.
It was like that domino effect. One thing falls and then everything else starts to topple.
Governments around the world had to step in to try to prevent a complete meltdown.
And that's when we saw those massive bailouts, trillions of dollars being pumped into the financial system.
It was a desperate attempt to stabilize the markets and prevent a global depression.
So the 2008 financial crisis wasn't just about numbers and markets. It was a stark reminder of the fragility of our systems and the powerful role that human psychology plays in shaping financial events.
And in the final part of our discussion, we'll delve even deeper into those psychological factors and explore what we can all learn from this experience to hopefully prevent similar crises from happening in the future.
Okay, so we're back and ready to wrap up our look at the 2008 financial crisis. We've talked about subprime mortgages and CDOs and all that fun stuff. But now let's really zoom in on the human side of this story. Because as we've seen, human behavior played a massive role in how this whole thing went down.
It's fascinating, right? We like to think we're all rational actors in the market, but when things start to get shaky, our emotions can really take over.
Exactly. We talked about herd mentality before, that urge to follow the crowd. But why do we do that?
Well, think about it from an evolutionary perspective. If you see a group of people running away from something, your instinct is to run to right.
Yeah, you don't stop to ask what they're running from, you just go.
Exactly. It's a survival mechanism. But in the financial world, that kind of blind following can be really dangerous.
Because it can create a stampede where everyone's selling their assets in a panic, driving prices down even further.
And it feeds on itself. Fear begets more fear.
And that fear is amplified by something called loss aversion.
Ah, yes, loss aversion. One of my favorite cognitive biases.
Could you explain that one for us?
Sure. So basically it means we feel the pain of a loss much more strongly than the pleasure of an equivalent gain.
So like losing $10 feels worse than finding $10 feels good.
Exactly. And during the 2008 crisis, that fear of losing everything led a lot of people to make some really impulsive decisions.
Like selling their investments at a huge loss.
Exactly. They were so focused on avoiding further losses that they weren't thinking clearly about the long-term consequences.
So what can we do to protect ourselves from these biases?
Well, the first step is awareness. Just knowing that these biases exist can help us make more rational decisions.
So next time I feel that urge to follow the crowd, I should take a step back and ask myself, am I really making this decision based on solid information, or am I just getting caught up in the hype?
Exactly. And don't be afraid to seek out different perspectives. Talk to people you trust. Do your research and try to see the situation from multiple angles.
It's like getting a second opinion before making a big decision. Makes sense.
And on a practical level, having a solid financial plan can make a big difference.
Like diversifying your investments, having an emergency fund, and not investing money you can't afford to lose.
Oh, great advice.
So the 2008 financial crisis was a powerful reminder that while markets may seem complex, they're ultimately driven by human beings with all our flaws and biases.
And understanding those human elements is essential if we want to navigate the financial world successfully.
And avoid repeating the mistakes of the past.
Well said.
Well, that's our deep dive into the 2008 financial crisis. We've covered a lot of ground, but hopefully this has given you a better understanding of what happened, why it happened, and what we can learn from it. A huge thank you to you for joining us on this journey. We know your time is valuable, and we appreciate you spending it with us. If you enjoyed this deep dive, please hit that like button and subscribe to the channel for more deep dives like this one. Until next time, stay curious, stay informed, and remember, sometimes the best investment you can make is in understanding yourself.